So the way that this works is the volatility. So we just took a look at that. You know, this thing's bouncing around. So that's gonna determine, the more volatile it is, the more jumpy a stock is, the higher those options are going to be priced. So the other thing that determines the value of an option is how much time is on it. So these are months right here, these division points. And what's really, really cool, a really cool innovation that's happened in the last few years is weekly options expirations. So in the old days, we used to have to wait until the third Friday of the month. We just had one options expiration per month. Well, what's happened starting in about 2006, they started rolling out certain stocks and indices that you could trade weeklies on in 2007, and they've been actually adding to them every year. So we've got a lot of choices now, and this is really cool. So if we take this options expiration right here, and we say this is the 16th down here, and we got about 2 weeks. So this amount of time is going to have one price on it, this amount of time is going to have another, and the further out in time we go, the more valuable these options are, because of the probability. Options are priced based on probability of the underlying getting to whatever price. Now I've got some more charts that'll explain this a little bit better. So here's call options. So call options are all lined up here. Now the stock right now is 118.30. So that's the price of the stock. And what a call option does, it's kind of a cool thing, is it gives you the right to buy the stock at a certain price for a certain period of time if you're to buy a call option. Now, this is interesting. If you go down here to the 110 strike price and the stock is already up at 118.30, you can see that there's a certain amount of intrinsic value in the price of that option. In fact, there's the difference between 110 and 118.30, you have $8.30 of actual built-in intrinsic value. Now you'll see that the option is priced actually a little bit more than that. It's priced 50 cents more than that, and that 50 cents represents the time value of the option. So all of these options have a little bit of time value attached to them. Now, this is what's really interesting. I want you to kind of file this away in your memory banks, is when you start getting out of the money. In other words, the stock right now is 118.30, and we jump all the way up here to the 120 option. Well, this 120 option has no intrinsic value at all. It's all time value. So this is $1.19 of time value, and that's based on the probability in this period of time over the next 2 weeks that this stock is going to get up and past this options price based on the volatility of the stock and the amount of time left. So this really complex mathematical formula spits this out. This is options worth $1.19. Now these are actually the actual real prices that I took off of the options chain. So this is, this is real life kind of stuff here. You go up here to 122, there's less likelihood that the stock's going to get up there in the amount of time we have left. So that is 50 cents of time value. All the way up here, there's very low likelihood. As you can see, this is all the way up past resistance. This would have to get to a point that the stock has not been to recently, and it would have to do it in a very short amount of time. So this option right here at 124 is priced fairly cheaply at 16 cents. So as you can see, the further the call options get above the current price of the stock, the cheaper they get. So this is just some basics about options pricing, but it's going to come in really handy in just a few minutes here. And that works the same in both directions.
To watch the next video on how to cash flow the stock market for fun and profits, subscribe to this channel for free by clicking the button below.